welcome along to the Property Academy podcast by Urban Partners. I'm your host here tonight.
I'm Andrew Nicol.
And today on the show, we're talking about the top 8 trends in the property market for 2023. And we've got a whole heap of data that we're going to share with you so you know what to look out for during this year. Now, for you guys watching on YouTube, you're going to be able to see these graphs, but for you guys listening to the podcast, no trouble at all. We'll describe everything for you. Now, trend number 1 is that house prices are likely to bottom out in 2023 and at some point will start to increase. And one of the things I've been really looking at is this table that we've got in front of us, Andrew, where we've summarized for all of the major banks and some of the major financial institutions of New Zealand when they predict the property market is going to bottom out. So for Kiwi Bank, they're thinking July to September 2023. Tony Alexander and us, we think the same. But Treasury and ANZ, they're thinking Q4 this year, so between October and December 23. Reserve Bank, Westpac, wee bit more conservative. They think early to mid next year. But you can see there, the fact that Kiwi Bank, Tony, Treasury, ANZ are picking mid to late this year, that we're going to see the bottom of the market with some potential recovery after that. Hey, that's one trend that I think a lot of property investors are going to be looking out for, trying to pick that bottom of the market. But up until that point, we're still likely going to see some amount of property price decrease.
Trend number 2, we're going to see inflation hang around for longer than what most people are probably expecting. So in 2021, inflation skyrocketed way outside of the normal 1 to 3% band, and it peaked, as you can see on each graph here, in 2022 at 7.3%. So we're going to see high inflation for a while. And when I say high, I mean outside of that normal target of 1 to 3%. So by the end of this year, we're expecting, or the banks are expecting, inflation to be around the 4%. It's still going to be higher than what the Reserve Bank is trying to target.
Yeah, so one of the things I've been trying to do recently, since forecasting is so notoriously difficult, what I've started doing is taking all of the bank's predictions,
Law of averages,
and taking the average of it. So when I look at the average of what all the various banks are saying, and I've stolen this one from the New Zealand Institute of Economic Research, when you average out those bank forecasts, they're predicting that inflation will still be 4% at the end of the year and that we won't come back into that 3% band until about mid-2024. But that doesn't necessarily mean that we should expect interest rates to stay significant at the higher levels we have today up until that point. But trend number 3 that I want to talk about is that interest rates will continue to increase in the early part of the year, and they will likely start to trend down once we get to the end of the year. Now, one of the things that's interesting is over the last kind of 18 months, we have seen interest rates skyrocket. The Reserve Bank has lifted the official cash rate from 0.25% all the way up to 4.25%, which is what we currently see today. Now, they're predicting that they're going to raise it by about April to 5.5%. Now, that is going to cause mortgage interest rates to rise up until about April. I'm expecting them to peak around that April, May.
So you've said in the past that a lot of these increases have already been priced in. You don't think so this time around?
No, that's not what I'm saying. I'm saying that some of the increase will flow through.
Right.
Now, the reason we say, or the way we calculate whether some of it's priced in or not, is we can look at the difference between the official cash rate and the wholesale interest rate. Now, the official cash rate is the Reserve Bank's interest rate, and the wholesale interest rate is what the banks pay in order to borrow money. And when I compare those two and look at the differences between them at the moment, I can see that wholesale rates, what the banks are paying to borrow money, is higher than the historic average when you look at, well, what's the difference between the two? And so that's telling me that the financial markets are already pricing in some of this higher increase. So although the Reserve Bank is going to increase interest rates by about 1.25%, or at least that's what they're currently saying, I don't believe that all of that is going to pass through into the, especially the 1-year interest rate.
And actually, just at the time of recording this afternoon, I did see one of the major banks, I think it was ASB, has brought down some of their long-term interest rates. So now you can get kind of a 5 years around that 6.5%. So that's what you tend to see when that market kind of is shifting. You'll see the banks giving lower, longer term rates to get people locked in. And if you really want certainty, that might be what you do. But it might be advisable to talk to a broker and actually maybe go on some of the higher rates, the short-term rates, and then that'll tip again.
One thing that I would say is that's not necessarily the banks trying to be underhanded and get people to just fix for longer. Because if the bank is lending to you for 5 years, they're borrowing that money off somebody else and then lending it to you with a margin. So it's not like they're being underhanded, trying to get you to trick you into fixing for a longer time. They're providing that option. It's not like they're doing something that's underhanded.
Yes, correct. Trend number 4 is you're going to see the buyer's market continue throughout the year. So the buyer's market will continue, in our opinion, for the whole year. So what that means is property sales are decreasing, fewer properties are being sold, and we haven't seen a whole lot of properties come onto the market, but because things are taking longer to sell, there are more properties available if you are a buyer at the moment.
And we have seen those total listings available on the likes of realestate.co.nz increase from about 13,000 properties all the way up to 26,000. So they've more or less doubled over the last kind of year. Now, again, that's not because we've seen a whole heap of more listings, but it's because people are buying fewer properties, and so those are accumulating. We are still well below historic averages, though, in terms of the number of properties available for sale.
And of course, if you're a buyer in the market at the moment, you've got more options available and you've probably got more time to negotiate because you've got less competition out there. So it's really good news for buyers who are buying this year and in a position to buy.
And trend number 5 is I think we're going to see first home buyers and property investors buying with cash. Those are going to be the two groups who are going to prop up the market. And my evidence for this is who is currently buying the properties at the moment. So in front of you, I've got a comparison between June last year and December last year with what proportion or what market share each of the buyer groups made up. And what we can see is that fewer people are moving house in terms of selling their owner-occupier in order to go and buy another one. First home buyers, they've increased their share from about 22 to about 24% of the market. Property investors buying with a mortgage, they're pulling back a wee bit, but investors buying with cash are coming in and filling some of their place. And so these changes are small, but they are impactful in terms of which buyer groups are purchasing these properties. So main two that are pulling forward, people who are buying their first home and investors purchasing with cash, people who are pulling back, people moving house, and those investors purchasing with a mortgage.
Trend number 6 is you're going to see more developers go broke, and we're seeing an increased number of articles in the New Zealand Herald and in stuff where developers are going under. And actually, typically at the moment, these tend to be some of the smaller developers, and my guess is they probably have less weight in the market. They probably have less fat in the development, so they might not have the ability to kind of lean on a placemakers for supplies or have more staff. So, you have a couple of people sick or leave and go overseas, all of a sudden it has more of a drastic impact. What this does mean is if you are buying off plans or you're doing a build, you're going to need to do really thorough due diligence on any developer you're buying from. If you're buying with a progressive payment contract, so where you're buying the land and making payments to the developer as the build completes, then you need to be really careful that you've got some sort of guarantee in place, like a master build guarantee, in case that developer does tip over.
And I think my last trend is that the election will have an impact on when people buy. And it's all going to come down to how the polls are looking a couple of months before the election. So what we typically see in the run-up to that election when we're about to go out and vote is we see a lot of people hold off on the property market. And it all just comes down to uncertainty. You'll hear some policies you like from some parties. You'll hear some policies you don't like from some others that will potentially impact your property investment decision or would impact your decision if they were to get into power. And so because of that uncertainty, you might just hold off a bit. That's going to be one trend, but we're also going to see the opposite as well. I think if it looks likely that a government is going to come in that's got some pro-property investor policies, some policies that are going to benefit property investors, then I anticipate that some will go ahead and make that decision to purchase. And the reason they might do that is if you think, you know what, it's looking pretty likely that a government's going to get in, that's going to take away interest deductibility, for example. If that happens, there's probably going to be increased demand for housing, see more property investors coming into the market, maybe prices start to crop up a little bit. I'm going to get in now because I think it's pretty likely that's going to be repealed. So there'll be those two trends. Some people will hold back. Maybe some of the more savvy investors, if they want to take a punt, they might start to get into the market.
And trend number 8, I think you're still going to see people feel a bit down on the property market for the first part of the year, but then probably sentiment's going to pick up in the later part of the year. And this is going to be because even though we probably shouldn't be surprised, and if you're listening to the show, you probably shouldn't be surprised that there are going to be rises in interest rates, that coupled with some more negative growth over the next 6 months, that will cause people to still feel a bit down on the housing market, coupled with probably actually the fact that a lot of people are coming off their fixed rate on their personal house or maybe a rental property that they fixed 2 years ago. We're going to start to feel the pinch of those higher interest rates. Then in the later part of the year, we're probably going to see some positive news. We might have a change in government. All of a sudden, people will be feeling a bit positive again and be getting back into the market.
Well, I think there are going to be two main things that are going to make it positive. Once there is a general feeling that interest rates have peaked and that they might start to be coming down, that's going to start to change sentiment because investors are forward-looking. We're going to say, not where are the interest rates today, but where are they going to be in a couple of years' time? Where are they going to be in 12 months? And if it's looking like inflation is starting to come down, the Reserve Bank's winning there, and people expect interest rates to come down, I think that's when you're going to start to see a pickup. And as well, if Kiwi Bank and ANZ are correct and we see a bottoming out of house prices in mid to late of the year, that and the interest rate conversation, that's going to start to change mindsets. And if there is some change in tax policy, that could play into that as well. But these are the top 8 trends to look out for. But Andrew, some people might think, oh, surely these predictions aren't worth the paper they're printed on because you don't necessarily have a good track record of picking trends.
Oh, look, I got one wrong. So in one of the investor chat groups, I did get into a debate with Lynette Scott and we made a prediction of the Canterbury housing market growth over the past 12 months. Anyway, I'm sad to say, because I relied on my friend and local economist Edward Christian McKnight, I got it wrong.
How much did you have to pay her?
I have to make a $500 donation to the bird rescue. I think it was Dunedin Bird Rescue, which I'm more than happy with, but I am also going to accept that I got that one wrong.
What would you get if she won? Oh, sorry, if you won.
I would have been happy because all my houses would have gone up in value.
No, but
it was $500 to a charity either way. So there were.
So was the charity the Eliza Nicol Foundation?
I hadn't decided.
Right, let's wrap it up there. But please don't forget to rate, review, and subscribe to the podcast. It really does help us get the message out to more people. And hey, if you're watching this on YouTube, let us know down in the comments what trends do you expect to see in 2023? Let us know down in the comments. It would be great to see your feedback. Thanks for listening to the Property Academy podcast. I'm your host, Hugh McKnight.
I'm Andrew Nicol.
I'm going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the property market. Until next time.